introduction.
Yes, sure.
Hello everyone, my name is Hitesh and I would like to take this opportunity to welcome you all to Elevate 21. Elevate is a 5-day event starting from today and it goes till 31st of August. During these 5 days, there will be 5 keynote. During these 5 days, there will be 5 quiz events and 10 keynote speaking sessions. We've already finished our first keynote session with Sudeep Bandyopadhyay. I hope you had a good time and a lot of learnings out of this. And this keynote speaking will even be more interesting one because we have one of the industry leaders and a big time influencer. He is known for his trading strategy and he is very precise with his work. And before I almost forget to mention, there is a cash prize of more than 1 lakh to be won in this event. So do stick on to this webinar because this could be helpful in the quiz. Now, our speaker of this keynote session needs no introduction. He's an alumni of BITS Pilani. He's previously worked as an analyst in Bank of America and was also in the software domain for Pramati Technologies. He is well known for his trading technologies and trading acumen. He is the co-founder of Investobull and he has a famous YouTube channel which garners a lot of attention. He has more than 2 lakh subscribers and I present to you Mohit Gupta. He'll be talking about short-term trading strategy. Mohit, the podium is yours.
Hey Hitesh, thanks a lot for the great introduction. So guys, we will just get started. Just give me 1 minute. I will just share my screen. So I hope everybody can see my screen. Once you can see my screen, just give me some affirmation that you guys are able to see my screen. Okay. Okay, great. So again, yeah, welcome everyone to Elevate 21, and this session will be about how to select stocks for basically short-term trading or swing trading. Right. So I'll just get started on this session, and I'll just take you guys through this presentation. So let's quickly take a look at agenda for today. So we will try to understand what is short-term trading first of all. We will try to understand why short-term trading is better and why should you approach it as your like go-to trading strategy or go-to trading style. I will also talk about what is actually a techno-funder trading. That is what we are going to focus in today's session. A style of short-term trading which is actually very suitable for current market scenarios as well as in general to avoid all the phases a trader goes through in his career, in his trading career, to avoid those losses and all those things. It's a very good style of trading with obviously a lot of benefits over the traditional swing trading strategies. We will see two ways in which we can execute this techno funder trading, which is a pullback strategy and breakout strategy. And then we will see how we can use tools to find out stocks which we can use for this swing trading, along with the risk management and how the execution part is going to be in this trading strategy, right? So first of all, let me take you to definition of short-term trading, especially for people who are new or who are not familiar with trading. So short-term trading, when we talk about short-term trading, it means that it's a trading style in which we can go long or short for a short period of time. Now, this definition of short period of time is not actually very well defined short period something, and it's a subjective. We can even hold it for 1 or 2 days. We can even hold for 15 to 20 days. We can even hold for 3 months to 6 months also. Now, depending on the duration that we hold, usually this is classified further into positional trading, swing trading, but in general, everything is same. Basically, you have to hold your positions from anywhere from 1 or 2 days to up to 3 to 4 months also you can hold. So this is something about short term trading, and it is also referred to as swing trading a lot of times. Why? Because we tend to capture swing moves in this trading. So when you talk about trading, right, so market moves in swings, right? If you are aware of movement of market, so you may see that market moves in something called upswings and downswings, and it is called swing trading. We try to capture these swings movement. So whenever market tries to make this movement, these swing movements, we try to capture this movement. That is the reason why this trading style is called swing trading style. Now going forward, so I have a chart here, so it's a chart of Berger paints, and I will try to explain you what possibility of swing trading is here. So, for example, you can see buying here and selling here, buying here and selling here, buying here and selling here. So, in an uptrending stock, capturing the upswings is one form of swing trading, capturing these swings, right? In an uptrending stock. Similarly, if a stock is trending downwards, so capturing that swing moves where the stock is going down or shorting in those things is another form of swing trading. But in this scenario, we go short on that stock or we sell those stocks. Okay, so these are some examples of swing trading. So swing trading, as you can see, right, there can be possibility of holding that stocks for maybe 1 week, or maybe it can even extend up to maybe a month or maybe up to 2 months, depending on how you book your profits, whether you are trailing your profits, is your stop loss hit, or depending on the scenario your trade is going through. Depending on that, your position will take that much time, right? So now, first of all, we must try to understand why swing trading is better and why should you approach swing trading, especially the techno funder trading that we are going to discuss today, right? So swing trading is definitely better because it has relatively less risk if it is done systematically. Why? Because in intraday, right, movement can be defined by hundreds of factors which are not in our control. But in swing trading, we can have some control on technicals, a better control on technicals, a better control in analyzing the fundamentals of stocks. So it is relatively less risky because we have to not to make immediate decisions. We are not having that paranoia of like, okay, I'm getting in loss, I'm losing, just punch in an order with double the quantity or triple the quantity. So it's relatively a calmer style of trading, not very aggressive style of trading. So there is very high chance of you executing in it properly and not making any mistakes, right? This also beats volatility and stop loss hunting. So in intraday, there is a high possibility of your stop loss being hunted down by operators, by system errors, by lot of errors is there. But that is taken care in swing trading or short term trading or positional trading, whatever you may call it. It also suits majority of the people because when you do intraday trading, you have to be on your system for much period of time, right? A lot of people sit in the morning and they just watch their screen till 3:30 p.m., right? So this may not suit majority of people because a lot of people will have some day job along with the trading, or if they are exploring trading or whatever they are doing. But if you do swing trading, it needs least time for execution. You have to just execute some trades and you have to wait for either target to be hit or stop loss to be hit. And it doesn't need anything to, like, it doesn't need you to be in front of computer and you have to keep staring at your positions, right? And also there is a slight possibility, though it is not recommended, I'm strictly not recommending it, but in case you get horribly wrong, or if you go horribly wrong, there is a chance that you can hold the stock for longer term if you follow the techno funda way of swing trading, right? So I hope everything is clear till now. Okay. Now let's understand the types of swing trading. So one, swing trading is purely based on technical analysis that we all know, that we are aware of. We don't care about what stock it is, we just care about charts. Okay, we see this is the level, this is the breakout level, and we trade it. This is one sort of trading. But what I personally prefer, and mostly I do, it's not that 100% of the times I do techno funda trading. Obviously there are a lot of times where I go purely based on charts, but what I try to do maximum number of times is what is called as techno funda investing, techno funda trading, right? What is this techno funda trading? Let's try to understand this in detail. So it's very simple. Techno funda trading just means that you have to trade, but you have to trade in fundamentally sound companies, or which companies or sectors which are in trend, which fundamentals are improving, or fundamentals are going to or fundamentals are going to improve, or their earnings are going to improve. So there is it's a mix of sort of technical analysis plus some sort of fundamental analysis. Again, you don't have to be expert in this. I will tell you how do you filter out such stocks, but it's sort of a blend of technical and fundamental analysis. Now, why should you go for techno fund trading rather than pure technical analysis based trading? So now here the thing is, most of experts or everyone basically trades breakouts, right? So when a stock breaks a previous high, it's called a breakout, a new range, a new territory, a lot of people call it. And this is where a lot of people take entry. But it is also a fact that almost 60% of the breakouts fail. So out of like 10 breakout trades that you take, 4 trades are only going to succeed and 6 trades are going to fail. So now to so this basically, right, so this shifts the probability in favor of market, not in favor of you. Why? Because out of 10 times, if you're going to lose 6 times, then probably you're going to lose your money also, right? So if we can, so basically when you buy or sell, right, your probability is 50%. When you take any trade, you either win or either you lose. If you increase your probability from 50 to anything more than 50%, is going to be in your favor over a long term, right? Again, remember, it is not just about one trade. It is going to be a long run. Let's say if you do the same strategy in like next 2 years, then probably, since we are inclined to, our probability of winning is something around 70% maybe, so we are going to eventually make money. So now technofunda in trading, the basic premises is that in fundamentally sound companies, breakouts are going to happen. Why? Because those stocks are going to rise eventually, though it will have swing moves, but it will rise, right? Apart from there, if fundamentals are not sound, for example in a lot of stocks, so those breakouts are going to probably fail, or maybe the stock goes into sideways movement. But in fundamentally sound companies, breakouts are going to succeed in a ratio which is higher than normal stocks, or which are not fundamentally sound stocks. Plus, after a consolidation period, if some breakout happens, that is higher, that has higher chance of succeeding. So to avoid this false breakouts, technofunda trading is very useful strategy. Excellent risk to reward on pullbacks. Now there are two ways to execute any trading strategies. One is breakout and one is pullback. These are two major ways to execute any trading strategies. When we execute, so again, we have already taken care of avoiding false breakouts, or I mean like our probability of success as breakouts we have increased by selecting good sound stocks. Now, if we trade not on breakouts but on pullbacks, then our probability is even going to increase further, maybe even up to 80%, right? Out of 10 times, we may hit 8 times correct, right? Or maybe 7 times. And that is good enough. If you do same thing in long run, you are going to make a very good amount of money if you follow this technofunda trading. So again, remember that since we are trading in fundamentally sound companies where fundamentals are good and stocks are eventually going to go up because a lot of people are invested in it, so it can be trailed, the position can be trailed for very, very high targets also. For example, I will show you in chart. For example, let's say, let's talk about Vedanta, right? VEDL limit. So you can see clearly in this chart, right? You can see the swing which has happened from almost 128 rupees to almost right now 300 rupees, 340 rupees high has been made. So this is an example of a trending sector, a trending stock where fundamentals or earnings has support, and there you trade breakouts or pullbacks. So again, you can trade breakouts as well as pullback in such stocks. How to trade it? Definitely, we are going to take a look at these strategies and how to get a good entry. But again, this can be converted into long-term trades also. Long-term as in like it can be traded for bigger positions. For example, if you have entered at this particular point of time, and you could have trailed with this small stop loss, you could have trailed up to this particular point or up to this particular point, depending on what your exit strategy is going to be, which is actually more than your risk to reward ratio. Risk to reward is very good if you consider such scenarios, right? Also, so universe is limited. So when we go about technofunda trading, then we limit our universe to limited set of stocks, and due to limited set of stocks, there is less noise because we have less stocks to monitor. And once we keep tracking these stocks, we get familiar with the structure of these stocks, how these stocks behave actually, and which is the most likely pullback point for any stocks. Because when you track, let's say 20 stocks, and you track it over a year, you get familiar with the stocks. You see how that stock behaved in the past, how that stock is likely to behave, or where that stock is likely to get a good support. So right, you have a good idea about that. So you limit your stocks, you limit your universe to maybe a 30, 40 stocks maybe, and then you trade those stocks. So again, now there are two major strategies of trading when you follow this technofunda trading approach. One is breakout pullback. This is again a common two common strategies, like you either do a breakout trading and you either do a pullback trading, right? So, for example, if I take you back to this chart, right? So you can see here. So this is an example of a breakout trading, right? This was the previous high, and when that high is broken, you take that entry, and this is called a basically a breakout trading, because that entry is happening at a level which is a breakout level. But if you take an entry at a level where it is pulling back, the price is pulling back. So price has moved up. Just give me 1 minute, guys. Okay, so the price has just increased, and then price is pulling up, and you take entry at the supports. So this is called a pullback strategy. Again, you are not taking entry at supports, you are taking when stock has pulled back from support. So here you can see the stock has pulled back from supports. So this is an example of pullback trading which you should be focusing on. So this is basic example of what we call it techno funder trading and pullback trading in techno funder stocks. Okay, now, trade setup. Let's take a quick look at what trade setup is, or what trade setups are you going to look to stocks. So first of all, our universe is NSE 500. We are not going to select our stocks outside the NSE 500 universe. Out of this NSE 500 universe, we are going to narrow down on companies which have good return on equities, or some basic fundamentals which we can basic which we can figure out some basic fundamentals. Also, like, we can choose trending sectors. For example, metals, ITs, these sectors are trending, and if you open the chart of these indices, it is very easy to open chart. Let's say you are on TradingView or any other platform, so you just track all the indices. You can simply go to chart of all the indices. For example, you can see I have all my indices here in place, and you can clearly find out indices which are trending, right? For example, metals, you can see these are trending because they're taking supports, right? So eventually these will pull back at most of the support levels, and when they don't pull back, they will hit your stop loss definitely, but your stop loss is going to be your losses are going to be very much limited, right? So you very basic strategies, you can do basic chart, you can figure out which stocks are trending and they are not in sideways. So for example, I can see here clearly that what is trending to me is something called metal stocks right now, and which is trending, and also IT stocks which is trending, right? For example, some of the stock which are in sideways is, let's say, private bank. So this is an example of sideways. So another small way in which you can figure out this is by checking out the moving averages. If your moving averages are actually sloping upwards, I mean, like, your moving averages are rising, you can say rising moving averages, those are actually trending, right? So here I'm using 50 MA, 200 MA and 100 MA for reference purpose on daily charts, right, to figure out trend of the stock, a general trend of the index, and then I am picking stocks for those from those index or those stocks, right? So this is one way to figure out trending stocks. Again, hey guys, can you hear me, Kritesh?
Yes, we can hear you. Actually, your screen got frozen.
Okay,
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 okay, okay.
okay.
I'm sorry for the difficulties, guys. We're coming back live again. Yes, Mohit, you can take over again.
Okay, great. So I was at again relative strength. So I'm basically I was telling you how to find those trending stocks. So trending stocks are which are basically outperforming with respect to your broader market index. So let's say it's Nifty. Nifty is our broader market index. So most of the stocks which are showing good strength with respect to Nifty, those are stocks which are trending about. So it's very easy to find such stocks. Try to find out stocks which are having good fundamentals in that. So okay, so I have my own list of, let's say, 40 50 stocks which I constantly trade, and I know, okay, these fundamentals are going to sound for these companies, and these companies are going to have a higher chance of breakouts, right? Higher chance of breakouts, and when breakout happens, that return that I'm going to get is more, right? Even if my losses will be there at false breakout, but those losses are going to be small, and profits are going to be big, right? So these are the basically you have to figure out these stocks, this stock universe and fundamentals. And then the important thing is you can either do breakout trading or do pullback trading. Breakout is simple: when a stock breaks a range, let's a 90-day range, or a let's say a 30-day range, then you can go for a breakout trade on charts. And if it is pulling back from some important moving average, then you can take the pullback trade. So now, important thing is, for example, in this chart of Vedanta, I have plotted out moving averages, which are 50 exponential moving average, 100-day moving average, simple moving average, and 200 days simple moving average. So in my trading experience, what I have figured out is that when a stock is trending, then most used moving averages from where the stock is highly likely to get pullback is 50 EMA and 20 EMA. 50 EMA and 20 EMA are those two moving averages on daily where stock is likely to take a pullback very easily. So you can use those pullback, but again, you have to see the chart. You have to observe from which moving average the stock is actually taking pullback. For example, you can see that here 50 EMA is something where Vedanta is usually taking support, right? And again, in the latest fall, it has taken support as 100-day moving average. So now you don't have to actually enter as soon as it touches, let's say, 50 exponential moving average. You have to make an entry at pullback. Now, what is pullback? So there is a candle which is actually touching that moving average. That is called a touchdown candle. So there is a touchdown candle, and when there is candle which is a reversal candle, which is a green candle, which closes above the high of that touchdown candle, that is the point where you enter the trade, and your stop loss is the lowest of the near about what are the touchdown candles are there. You put your stop loss at that point, and then you have to trail your targets. Again, what do you mean by trail your targets? As soon as the price moves in your favor, you keep on shifting the stop losses. Okay, so even if that stop loss is going to hit, your loss is going to be limited. If you are not comfortable with trailing positions, what you can do is simply you can how much is your stop loss, right? You can take that much as the target. But again, in this when we are doing techno funda trading, the key thing is here that we are going to capture big moves, big pullbacks, big swing moves. So here if we just put because our stop losses are every time going to be small, because we are entering at supports, right? We are not entering at breakouts. So for example, if you see, if I was entering at breakout, so my entry would have been at this level. So when I was entering at breakout and my entry was at this level, in that case, my stop loss would be big, right? And my target would be this much. But if you see, if we take a pullback entry at this point, then our stop loss has turned very small and our potential targets is going to be big. So if you do pullback entry in fundamentally sound stocks, that is going to actually give you a very good risk to reward ratio. So your risk will be small and your potential reward will be high, right? So this is very basic trading setup: entry, exit, stop loss. Entry is above the reversal candle, stop loss is low of the reversal candle, or one or two candle around reversal candle, or touchdown candles you may call. The lowest of that you can keep stop loss. Quantity, that is very important. How much quantity do you buy? So here comes the basic risk management rules, right? Because that will decide how much quantity you need to buy. So it's a very basic, straightforward, nothing new that I am telling, but something that I have modified a bit to my own liking. So let's say you have 100 rupees, you can divide your capital into 5 parts, let's say 20, 20, 20, 20, 20, and then you trade one trade with one part of capital. Now let's say you are trading one trade with, let's say, 20 rupees, right? You have 20 rupees, and now you know risk per trade. Okay, so for example, I have, let's say, 100 rupees. I take take at least 4 trades. So 25 rupees, 25 rupees, 25 rupees, 25 rupees. Again, 100 rupees is just a reference number. Okay, let me take it to 1 lakh rupees so that it is clear. So 25k, 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 and 25k. I just split my amount into four equal amounts, and then per amount I can risk maximum 1% to 2%. Depending on your risk capacity, you can decide it, but it is not advisable to risk more than 2%. So 1% is something very easy. So let's say I have to risk 250 rupees, which is 1% in this particular trade. So if my stop loss, as per as my entry exit criteria, if my stop loss is coming as 10 rupees or 10 points stop loss, and I can lose maximum 250 when that stop loss is hit. So that quantity is very simple. 250 divided by 10 equal to 25. This is the main key thing that helps or distinguishes whether you are successful or whether you fail at swing trading is your risk management, right? So if you follow this simple basic risk management rule, it is going to help you a lot, right? So again, so this is very basic simple rule. So you have to take pullback trading. You have to not risk 100% capital on one trade. You have to divide your capital into multiple parts. Then you have to risk 1 to 2% which per trade, and you have to take quantity, which is very important. Quantity as per as the risk management. Your stop loss is going to be deciding your quantity. So here you say whatever the stop loss may be, right? Whether it is 10 point, 20 point, 2%, 5%, 10%, your quantity will be adjusted in such a way that on hitting the stop loss, your loss will be same in all the cases. So this is the key factor which will distinguish your trading journey if you follow this strategy of swing trading, right? So this is a very basic risk management. Now, couple of points before we start Q&A session. So to improve accuracy, right? So these are some observations. Again, these are observations from my personal experience. So you have to trade pullbacks which are happening after deviating from MA in a while. Now, what I mean by this is, right, let's say the example is there. So if you're going to trade this pullback, I would prefer not to trade this pullback, but I would prefer to trade this pullback. Why? Because there should be some movement and then a meaningful pullback should have happened. If a stock is pulling back, then it is like going here like this, then I'm just going to avoid that stock because it is not pulling back immediately, right? Stock, if the stock has to be in trend, it has to pull back immediately. So if that pullback, you have to see if that pullback is happening after some time. It's not that is going up, then immediately coming down, then again going up, and you're taking that pullback. So if you follow this, it will basically, these are just small filters which will improve these strategies. Okay, you prefer again trending stock. Weekly supports are preferable, right? For example, if you see the charts of Aurobindo Pharma. So if I am going to show you charts of Oro Pharma, so we know that, okay, the stock is pulling back from here, right? We know that stock is doing a pullback from here, but most of the major supports are broken. But if we shift to weekly chart, we can see clearly that it is not a no man's land or something. It is actually 200-day moving average on weekly chart, which is one of the very important moving averages, especially for companies who are good, like who will eventually give you returns, because they should not go below that. They will change their whole the returns and everything. Investors will go out of the stock because a lot of technicals are also being traded. So I'm just giving you examples. So 200 DMA. So here is an important point from where pullback can be expected. So pullback can be happening. But again, see, this is not an example of like a stock where I would invest, because as I told you, I would prefer trending stock. So it is not trending. It has again changed the trend, which was upwards, and it has hit a stop loss here and changed the trend. So I would not use this stock, but I would prefer some other stocks, right? But it was just an example to show you, if from other in a trending stock, if weekly supports are there, then it is highly likely that it's going to bounce from there, right? Again, then you have to avoid pullback candles where very big shadows are there. So if pullback is happening, but the stock has gone 10% below and then it has moved up, you have to avoid those pullbacks. Again, good risk to reward trades are perfect. If you're seeing that your stop loss is too high and your target potential is very small because there is some other resistance after pulling back, then you can avoid these trades. So these are some simple and proven tips from my side to include. And again, one bonus, you can always use relative strength to find stocks which are actually showing good strength. So this is relative strength. You can use intradyscreener.com, and you can also check relative outperforms to find stocks which are actually pulling back. So these are the stocks which are sort of pulling back from moving averages because they are basically outperforming in short and medium term. So for example, in India, you can see that the stock is outperforming. In last 7 days, it has given like 20% return. In last 3 months also, it is giving outperformance. So usually you have to prefer stocks where, for example, Tata Elxsi is a stock which is like, these are the stocks which are basically increasing, dipping, and then increasing, right? This is basically a simple criteria. All your stocks which I've discussed will come in this category. You can eventually, you have to open charts and see, this is the filters, like you can easily find out stocks from there. So this was all about short term trading, how to select trading using
Using
techno funder
techno-funder
trading
trading
strategy.
strategy.
And
And
yes,
yes,
that's
that's
it.
it.
I
I
hope
hope
you
you
guys
guys
like the
like the
session.
session. Thank you so much, Mohit. It was actually informative, and we got a lot of insight about how does one go about doing short-term trading, swing trading. Because personally, I've been a trader myself, and I've been trading for almost 12 to 13 years, but I never had this kind of perspective about short-term trading. So thanks for the knowledge on that. Our viewers have got quite a few questions lined up. I picked up actually the six simple ones. So the first question which I got is, how does one choose or decide the strategy for the intraday purpose? How do you choose the strategy for that particular day? What's your rationale? How do you shortlist it?
See, so again, I'm saying that this is not intraday trading strategy. This is a swing trading strategy. So when we say swing trading strategy, it is not intraday. However, entry, if you're asking about how do we decide entry, then I have clearly told you that entry is going to be on reversal candle. So once a reversal candle is formed, right? For example, in this scenario, in this particular example I'm showing. So for example, let's say if we are going to trade this pullback, right? Or let's say if we are going to trade this bullback. So this is the touchdown candle, which has actually touched the candle, and then there is a clear reversal candle, right, which has showed that okay, there is support at this level and we are not letting the price go down, right? And when the price goes above this touchdown candle, you have to make an entry with the stop loss as the lowest of all the two three candles, like basically touchdown candle and reversal candle. These two candles lowest, whatever is the point is there, you have to place your stop loss below that. That is your entry candidate. So you have to enter on pullback because it's a pullback trading strategies. So let's say stock is just here, right? I can make an entry here also. So when I make entry here, my risk reward will be very very favorable. But if market goes volatile, for example, last few days, like last 5 6 days, Vedanta basically touched this 50 MA, then broke, and now it took support at 100 MA, right? So your stop loss are likely to hit there, and also you may have to wait for longer time if your stock starts to consolidate around that level. So that is why you have to take entry only after this reversal candle is formed. So pullback candle is important. Once your pullback candle is formed, then only you have to take entry, right?
Right, Mohit. The next question which I have is like, if someone is a new trader in the market, he wants to get into short-term trading or swing trading, what kind of technical indicators or tools would you recommend to start with?
Okay, so if you are going to if you are a beginner and you want to start with short term trading and you are confused like what should be your trading strategies, I think this should be your go to strategy. This is one of the easiest strategies to follow, and depending on indicators, depending on what time frame you are trading, you have to select your indicators. So for example, if you're trading for swing trading, right? So swing trading, you can select moving averages. They are one of the best indicators, right? Moving averages are one of the best indicators which give you trends and which help you to get perfect pullback entry. So in this scenario, in the studies that I've taught you, moving averages are the best indicator. But again, that RSI and ADX are two other indicators which I personally use. RSI is definitely used for gauging the relative strength of the stock. And also, I use ADX to figure out stocks from non-trending and trending. Again, I definitely, so you have to remember that indicator is not that I use this indicator and I follow this indicator. It has to be a overall perspective. So indicator is like one of the things. So let's say I have a checklist of 6 things. Indicators plays one small role, right? There may be indicator which is giving opposite signal, but if all the indicators are like pointing in the same direction, then probably that may be the correct direction, because it is a game of probability, right? We are not here to prove ourselves right or wrong. We are just here to figure out, okay, if my probability is going to increase more than 50%, by taking help of 2 or 3 indicators, if I am able to figure out, okay, my probability is going to increase from 50% to let's say 70%, then I will use it. So I personally use moving averages, I personally use RSI, I personally use ADX, and sometimes I use for volatility, I use average true range. But again, it's not that you have to depend on single indicator. These are indicators which I personally use, and they seem to work pretty good for me.
Thanks, Mohit. Because yeah, I mean, it depends on one's own trading style that what suits you and which works out for you. Right. Now, the next question was regarding the trading stop loss, which you have said. You said that you can keep trading your stop loss once the market moves in a direction, and you can benefit if the market comes down. Just in case it comes down, you at least don't lose money, make something out of it. The question which has come is like, how does one choose what should be my point of trading stop loss? Where should I put my trading stop loss?
That's a very good question, and again, it depends on your risk-taking capacity, your psychology when you trade. So there are a lot of algos written on this who trail like for every 2 rupees movement in your direction, the stop loss is trailed by 1 rupee. What I personally use is, let's say for example, I bought a stock at 100 rupees, my stop loss was 98 rupees, and my target was 102 rupees, and my target is 102 rupees, which has already been reached. Now what I do is I book 50% of the profits, and then I revise my stop loss to my cost price, which is around 100 rupees. And I don't trail the stop loss on every 1 point movement, but it should be like in multiples of my risk. If my risk to reward was, let's say it was 1:1, right? So I had 2 rupees risk and 2 rupees reward. 98 rupees was my stop loss, and 102 was my target. So if my target is met, right, 102, I book 50%, rest I revise stop loss. Then again, let's say it goes to 104 rupees, then again I book part profits and I revise my stop loss. So it's not that you have to revise your stop loss in every tick movements, though there are algorithms which are doing it right there. Usually you have to wait whatever is your stop loss, right? When that movement has happened, that amount of movement has happened in your direction, you can change your stop loss.
I mean, that's a very smart way to do it. Like book something and then keep trading your stop loss. That's actually a very good go-to strategy. The next question which has come is like, it's more on the psychological aspect of trading. They're saying that if you are trading and if you supposedly have a bad day at trading, what are the things which you should do and how do you just overcome so the next day you start fresh?
Okay, so if I understand it right, that you might have blown up your account and you want to start again.
Yeah,
So
I
your
mean,
first thing is you need to have a confidence to return to trading, right? And you have to have confidence to hold on to your positions. But all these confidence and everything is actually multiple of how good your strategy or how good your risk management is. If you have a good risk management and good perspective on managing your risk, then only these things will come into picture. If you come again with, if you, let's say you have 5 lakh rupees, you blew up that 5 lakh rupees, you came back with 10 lakh rupees, you don't have your risk management in place in this time, whatever you do, whatever strategy you get, you will eventually blow those 10 lakhs again away, and then you will further lose your trading psychology. So basically, right, your strength, your psychology, your mood in the market, your, see, I'll give an simple example. Let's say you take a position, right? I'll give you a simple example. So let's say Vedanta is at, or Tata Motors is at 285 rupees, right? And you have 5 lakh in your account. There are two scenarios. You buy Tata Motors worth of 1 lakh rupees from that 5 lakh rupees, correct? The second scenario is you invest all that 5 lakh in Tata Motor trade. Now Tata Motors fall by 4 points, correct? Tata Motors went from 285 to 281. So can you imagine what will be your psychology in the both cases when you invested 1 lakh rupees and when you invested 5 lakh rupees, or when you traded whatever, right? So
right.
you can clearly see that the more your losses increase, the more your mind goes for a toss, right? And you start to take wrong decisions. So the key learning is that you have to control your position sizing. You have to control your risk. Your psychology, your strength, your mindset comes from how good you manage your risk. The better you manage your risk, the better your mindset is. So next time when you come back to your markets, you have to come up with a solid risk management strategy. For example, I told you a very simple strategy where you take your money, you divide into 5 parts. Per part you do this is the my percentage for a day or for that position, and then you do it. Right? A simple strategy, correct?
Right, makes sense, right? Yeah, and the next question which I got is like more about how does Investobull kind of thing. The question is this: what are your learnings, or what was the thing which was most challenging for you when you started Investobull, and how did it go about becoming a brand which is right now?
That's an interesting question. So basically, right? So it's an interesting story how these tools came up. So when I started my trading journey, so one of the major challenges that I faced was there is so much of information available. How do I track these stocks? How do I track this information? Then I see whom am I trading against, or who are my competitors, or whom am I competing against. Obviously, we know that out of 100 people, 90% lose money in markets. Out of those 90 people, 88 are retail traders, right? Institutions make money. Now, how these institutions make money? They have all the data available. They have all the information available. They have all the data set, real time data, everything available. They have a proper management in the place, right? So, due to this, I started Investobull, which is basically working on creating tools which investors or traders can use in their investing and trading journey. So, these tools were started basically to help me in my personal capacity to give me edge over others. But since it turned out good, and when a lot of people started to like it, so I just thought, why not make it a product, a company, right? So that was the beginning of intraday screener, which is one of the very popular tools of trading. So right now, over 25,000 people actively use intraday screener for trading, and it gives you a bird's eye of market, which all the pullbacks, breakouts, and all those entries. So all these things are available in this tool. Again, when I made intraday screener, this was the first product that we Investobull developed. After that, we figured out, okay, we cater to the trading community, but what about investing community? So there are more investors than traders, right? So a lot of investors were asking, okay, trading tool is good, but what I need to keep my investment separate from my trading, because my investment is for my long term, for my future, for future of my family, right? So for that, we came up with a tool where you can basically focus on investing in long terms. You can find out stocks. You can like track your watch list. You can create watch lists. You can track these stocks, and so basically you can take technicals about it. You can track news about it. You can track fundamentals about it. You can track everything about your investments, and you can see which stocks are good to invest, which stocks are not good to invest, how that fundamentals are changing, improving, deteriorating. So this was whole idea about Investobull. So Investobull is primarily meant to cater to like investing audience, and intraday screener is one other popular tool which is meant to cater especially the traders. And again, Investobull fintech is working on a lot many tools which are going to help trading community in getting whatever market analysis or data analysis they want actually.
It looks like a very nice product and would be very useful if you're looking for investing. Thank you so much, Mohit, for taking our time and enlightening all our users, viewers about the knowledge about short-term trading and swing trading. In the end, it was actually a very good learning experience, and would like to thank you again for coming on our show. Thank you so much, Mohit.
Thanks a lot, Hitesh. Thanks for inviting me to the Elevate session, and I wish you all success, and I wish Elevate turns out to be a very successful event.
Thank you so much. And just one reminder for our viewers, please, at 4 p.m. the quiz starts, the first quiz. So please enroll if you haven't already enrolled and make gains out of it, because there's a lot of cash prize to be won. Thank you so much, everyone. And thank you so much, Mohit.
Yeah, sure.